Good afternoon. Thank you very much for joining us. We're going to kick off with the private equity outlook from the industry titans, which I would say is an aptly named session, as we have some key leaders from the private equity space. So David Rubenstein from Carlyle to the far left, or my far left, Robert Smith from Vista, Jonathan Nelson from Providence, and Leon Black from Apollo. Thank you very much. Unfortunately, we lost one who, unfortunately, David Bonderman is ill, which if anybody's been at the receiving end of my questions would say is probably a reflection upon me. But we're thrilled to be here and kick off on some of the trends in this space. So first, if we could start off with a question to David around, what are the biggest risks today that we see in the macro environment? Everybody I saw across a couple different panels talked about Brexit, about the currency, devaluations, around energy and energy prices. But, what do you think those key risks are, and how do they affect private equity?
Okay, well, before I do that, how many people here think private equity is the highest calling of mankind? Anybody? Okay, well, I do. Yeah. Okay, so the biggest risk to private equity in macro is, in my view, the U.S. government deciding to do something that would change the way that the business is operated. Ronald Reagan famously said the most dangerous words in the English language are, "I'm here from the federal government, I'm here to help you." And sometimes I worry that the federal government in our country and the governments in other countries might try to do something that would impair the ability of private equity people to do what they do. But if leaving that aside, I would say in this descending order, number one is a potential recession. We have recessions every year in the United States, every 7 years in the United States since World War II. The last one technically ended in June of 2009, so 7 years from June of 2009 would be June of 2016. So we don't have to have them every 7 years, but we tend to have them every 7 years, and maybe they go 8 years. So at some point in the next 2 years or so, it's likely, if history is an indicator, we're likely to have a recession. I think people may not have anticipated that. If you look at investment committee memos, sometimes people never assume there's a recession or coming on. So that's one possibility. Second possibility is the Fed gets it wrong about when to increase interest rates. Right now, the Fed has kind of signaled they're going to increase interest rates maybe once more this year. But suppose they decide to do it twice, or decide to do it at a bigger amount than people anticipate, and the market doesn't anticipate it correctly, that could have a big effect. Third is China's growth is slower than people anticipate. People are probably building in now that China will grow at 6 to 6.5% the next year or two. But suppose China would grow at 4 or 5%, I think that would have a big effect on the world. And last, I would say, if commodity prices and energy prices don't begin a slow upward tilt towards a more normal range over the next year or year and a half or so, I think that would have a big effect on the world economy. And so those are the things I think I most worry about in the macro sense.
Robert, do you have any other thoughts you want to add?
I do. I think macroeconomically, I think David nailed the big issues. I think the thing that we're facing and we're seeing as an industry is, I go back to the digitization of every single industry out there and the economies and how they're affecting it. So if you think about every single company, even that we own and we buy, we're digitizing those businesses. Well, the challenge with that, of course, and the risk is cybersecurity. And so it's a microeconomic risk, but it affects every single business. I tell many of our limited partners when we're having discussions, I say, if you're sitting in the room with your general partners or your private equity general partners, and you ask them, tell me about your cybersecurity policy, and they kind of look around the room without an answer, you should get up and leave. I think that every one of the businesses that we own and every industry out there, because of the way the Internet of Things is actually connecting every single business to every other through networks, sensors, and ultimately what I'll call cognitive-like solutions, there is a vast and a huge risk that if you don't manage that well, it can cause, I'll call collapses of businesses, and certain industries will slow down, and actually certain companies will go out of business. So I think that's one of the biggest risks that we face, and we have to think about as investors.
Mm-hmm. Yeah, as we look at the macro environment today, one of the things that's commented on pretty often is pricing, the pricing of investments in this current macro environment. And Leon, you were famous for quoted last year saying that you thought the markets were kind of priced to perfection. Do we still believe that's the case today, or do we really expect that some of these challenges we're seeing are actually starting to change the pricing environment?
Sure. One, it's great to be here with all of you. I'm just sorry David's not here. He was always my sparring partner. I'll have to figure out in the next hour who to spar with up here. Good start. I think we're in a price to perfection, turbocharged environment right now. You have PEs now at about 19 in the US. They're in the mid-20s in Europe, which is almost inexplicable. You have credit markets that look like they were beginning to become more reasonable at the beginning of the year, but they've now tightened again. So high yield, which had gone up to almost 9 in January, February, is now back to about 7.5. Leverage loans, 5. Investment grades in the 4 range. You know, the average PE deal now for a deal over 500 million is at an 11 multiple of EBITDA, which is even higher than pre-07 levels of 10.5. So against that backdrop, you have a GDP that last year, 2015, was at about a 2.4% growth in the US. It was predicted to go up to about 2.8 in 16, and it's now been lowered in the predictions to about 2%. In the world, the same thing has happened. What was supposed to be 3.5% is now 3 after 3.1 last year. And then finally, the new issuance of debt market has continuously gone down year after year. So this first quarter of 2016 is about 128 billion. A year ago, during that same period, it was about 200. 2 years ago, it was about 300. So you have less debt issuance. You have leverage ratios coming down. They're down to about 5.5 now. So PE deals require more equity in them. We're up now into the mid-40% level, up from the mid-30% level a number of years ago. So basically, you're getting hit from all sides. It's a slowing economy. It's a high multiple environment. It's a lower leverage environment. Yes, you still have low interest rates, but pretty hard to make the numbers work. I think, you know, our view has been to be patient, to stick to whatever model you have. Ours happens to be a value-oriented model, and obviously with very high multiples, one would think that would mean you know, we would have to be dormant. Sometimes the world doesn't work that way, even though the macro backdrop can be quite concerning or negative. Things can happen where things then can fall in your favor. There are a lot of transactions we've spent 1 to 2 years working on that just happen to all happen. We've put out 5 billion actually of equity in PE during the first quarter of this year, 3 billion of it from our funds and 2 billion to co-investors. And we've been able to do it in transactions where they've averaged an EBITDA multiple in the low 6s against an 11 backdrop. Deals like ADT or Fresh Market, or we'll see what happens with Apollo Education. That's the jury's still out, or financial deals in Europe, insurance companies. So sometimes you stick to your knitting and things fall in place the way you want them to, even in a bad macro environment. But I have to say it's tough out there right now, because I think the markets are priced to perfection overall.
Yeah, so we do put together, you know, off the back of that, the macro backdrop, we spend a lot of time putting together a GP questionnaire to talk about what are your key concerns, what are the risks, or what are the things that you're thinking about. And some of it probably is a bit more micro, but growth is a big area of focus for everyone, particularly last year. So do you agree that growth is your big worry today, Jonathan? And given that as a backdrop, or given the macro conversation, how do you find growth, or how do you generate value in that environment?
I remember that GP questionnaire, and
I put Mario's name on it, but it was really me.
oh, okay, it was well done. Actually, I was not one of those that checked growth as a key concern, because it's not, and it's probably a useful segue to get off of macro and GDP growth and into the micro world that we live in. If I look back at our portfolio last year, top-line revenue growth grew on average 8%. This year, we're expecting 14%. And of course, EBITDA grows faster than that because there's operational and financial leverage. So why is that? Because, and this is a portfolio that's dominated by US and European investments. In other words, we're uncoupled from GDP growth. Now, in our case, it's because we focus on sectors that are growing much faster than GDP. Media, telecom, if done right, should grow, and it shouldn't be surprising, at rates that look nothing like GDP. And in particular, if you pick companies that are winners in fast-growing sectors, it should be even better still. So that when I think about what investment committee is concerned with, it's in the US and Europe, it's not GDP growth. Of course, you have downside scenarios, and they include recession that David mentioned, I think, top of his list. But that's just a severe case of absence of growth. That's actually, then everyone's plans are knocked back. But whether the US grows at 2 or 3%, really you can't find that in our returns. And if Europe is 0 or +1 or -1, at least over the last 4 years, it's worked out very well. And these companies are growing, which is the beauty of private equity, is that we're not an index. We don't invest in an index, a country index, a GDP index, and the evidence comes in every year in the portfolio performance. So no, I'm not concerned about growth. I would be if I were a public policymaker, and I'd be focused on unemployment, on interest rates, et cetera. But as an investor, thankfully, we don't worry about something that actually we have no influence over.
Andrea, one of the things I would mention is one of the other macro factors I didn't mention, but I think is a real factor in the next 6 to 9 months, is who the next president of the United States is going to be. I think the markets will build in shortly the presumption that Hillary Clinton will be elected, rightly or wrongly, whatever you might think, that's what the markets, I think, will build in. And to the extent that the election gets closer and a different result will be seen as possible, I think the markets will be spooked a bit because they won't know exactly what the outcome is going to be. It's more predictable what likely the economic policies will be for, let's say, the Democratic candidate than maybe the Republican candidate. And so my view is that that will produce some uncertainty in the market for quite some time. And I'm just curious, I just like of the people here, how many people here think that the Democratic nominee, Hillary Clinton, will be the next president of the United States? I'm just curious. How many think the Republican nominee, likely Donald Trump?
Wow.
How many people think Ted Cruz will be the nominee? Okay.
Nope.
How many people think the economy would be better off if Hillary Clinton was elected? How many people think Donald Trump? Okay. How many people are afraid to say? All right. Okay. Just curious. Okay. I do think that's a factor that will be taken into account.
Okay, I'm going to shift topics to one that we've spent a lot of time on at Hamilton Lane. So we've been 25 years in private equity. Increasingly over the last 10 years, we've been really focusing on credit. And credit has now become a material part of our deployment of capital across portfolios. So maybe, there's a number of organizations here, pretty much all of which have some credit component to their organizations. Maybe you can touch on, what is the opportunity, Leon? Maybe you can kick off, having really been in the business for a very long time with kind of a bifurcated approach to, actively acquiring companies. But how do you see that developing? Is it what Josh had said maybe in one of the earlier panels, that there's just a huge amount of money chasing yield, and is that why LPs are rushing into this space, or what should we expect from it going forward?
I don't think there's ever been a better time for everybody up on this stage and everybody who's involved in alternative asset management than today because of the huge credit opportunity. Credit has been in our DNA at Apollo, going back to the fact that most of us were all trained in the Mike Milken School of Credit back in the 70s and 80s. And then when we first started Apollo, we managed the executive life portfolio, and we do a lot in distressed debt. But I think a real sea change happened with the financial crisis, which opened up an opportunity for many of the alternative asset managers. And that basically were the two secular tailwinds converged. One being a very low interest rate environment the last 7 years, so that you have a huge amount of pools of capital out there, including many of the LPs that represent state and corporate pension funds, as well as others, who basically just can't cover their 8% liability bogey by investing in treasuries and investment grade debt. And therefore, they've had a real need now to consider various alternative options on the credit side. The second tailwind has been the more severe regulatory environment that came out of the financial crisis, which really pushed a lot of the traditional providers of credit in the banking and investment banking community to have to shrink their balance sheet and meet various leverage ratios and basically shut down a lot of their proprietary trading and debt issuance operations. Both of those trends have provided huge opportunities for institutions such as ourselves to be able to fill the void, if you will, in terms of the needs of so many of the different pools of capital, ranging from sovereign funds to pension funds, and insurance companies, and others. So, you know, what we've tried to do basically is to create a Chinese menu, if you will, of different credit products, ranging from insurance-linked type securities and CLOs that can yield 6 to 8% type returns, to all types of originated products, from life longevity assets to ship financing, to energy credit, to aircraft leasing, and infrastructure funds, emerging market debt. I mean, the list is very long. And then we've created in-house something called MidCap, which is now a $7 billion capital generator on the origination side. And then finally, we do what's called opportunistic credit, which is distressed and stressed opportunities, providing mid to high teens type returns. The whole idea is to be able to work with a wide spectrum of pools of capital and to dialogue with them, if you will, to figure out where they want to be on the yield versus duration spectrum.
Right.
And as I said, you know, I don't think we want to be a BlackRock and do 10 BIP type of business, but I think there are a myriad of products out there that are very, very good business for us, very much down the alley of going back to what our DNA is, where there's a crying need in terms of the search for yield,
filling that gap.
that exists both here and in Europe.
Okay. Jonathan, I know you have a big team now dedicated to this as well, and you know, are you seeing some of the same trends, and you know, what are the themes that you think are interesting in the credit space? And we do expect LPs have a lot of dollars to put towards this, so you know, focused on credit.
Well, First of all, I think credit and equity, they're different disciplines, they're different cultures, and the key to success is that folks are actually very good at what they do, and you can't repot an equity guy and turn him credit. This is my view, and vice versa. And that's what we've done at Providence. We have a very skilled group in credit, and it's been complementary to what we do, but they pursue strategies which inform us but are really different than equity. So for example, loan origination, which has been, I think that's a franchise business. It started in the secondaries because of our timing,
Right.
7+
We'll see
years
more of
ago.
it.
That's coming back. That is back. It's probably more of a hybrid right now, primary and secondary. But the leverage loan business, given the consistent and forceful move by regulators to push the banks out of that business, is uneconomic. That's here to stay for as long as we can see. So I like that business, particularly when you have an origination team. There are other strategies, market neutral strategies, which are really helpful for those plan managers that are worried about interest rates. And real estate is interesting. Distressed will be. No one knows exactly when you want to be in that game, but that's clearly you've got to have your partners lined up. And energy. So all of them are interesting, but I think it starts with where are the distinctive skill sets of the folks, whether it's at Leon Shop or Carlisle, or that's where the starting point is, and where there's an overlap between those distinctive competencies and where you see market opportunities, which is very different than equity. Equity is a steady Eddie business. You can't market time it, I don't believe. And credit opportunities, with the exception of the leverage loan business, is they're perishable. Much shorter time frames, tighter windows, and you have to be poised with the right group to capitalize on it.
Right. Okay.
Yeah. If you don't mind, I'll pick up on that. I mean, part of what we're seeing in our credit business, we're specialists. And what we found in starting this business 16 plus years ago, there weren't many folks who actually knew how to lend to our space, enterprise software, data, technology-enabled service, et cetera. So as a result of that, we needed to some extent train and help the creditors to actually now lend money to our space. And what we found is there had been a lack of specific understanding, which gave us an opportunity to create a group that are specialists in lending in our space. Now, what's neat about that is our limited partners now recognize the expertise that we have in our private equity business can then translate into the expertise in our credit business. And part of that has led to a number of the larger LPs of ours, and even in what I call the sovereign wealth fund, saying, gee, this is an area that's growing. They're living on often a zero interest rate environment or negative interest rate environment, and they see the sorts of credits that we can actually not only originate but now participate in and bring specific insights into how those credits are underwritten. So that has been one of the major underpinnings of the surge behind credit in our space. For example, many of the larger banks and financial institutions have not picked up on that or figured out that there is an opportunity there, and to some extent, I hope they never do. But on the one hand, on the other hand, those who have been in our space for some time have actually developed more and more expertise, and gives us the ability to demonstrate our capabilities in structuring deals so that we actually get what I call the benefit of the doubt when we are actually seeking credit for transactions that we're initiating.
Right.
I think the biggest phenomenon there are two phenomena that have happened since the Great Recession. One is the one that Leon referred to. The Dodd-Frank legislation basically said to banks, more or less, don't lend so much money or get out of businesses that you're in, or you have to change your ratios. So they have left a wide swath of territory available for people who are not regulated like banks to go in and provide credit. The second phenomenon is that the low interest rates we've seen over the last couple of years have scared a lot of people who normally get income-related investments, credit investments, because the normal interest rates you're getting or dividends are so low. So there's been a niche that the private equity firms have filled, which is to say we can provide credit for certain types of products where we're not regulated like the banks, and we can provide outsized rates of return relative to what you might get in a normal fixed income instrument. So people have come to people that are pretty good at getting outsized rates of return, like the firms here, other private equity firms, and said, look, you guys know how to get better rates of return than normally I can get on a fixed income instrument. What kind of product can you come up with where I'm going to get some current yield, which I want, higher than I get on a bank deposit, or some other normal kind of fixed income instrument, but give me some equity upside. So the most attractive products we see are ones where we're going to give a current yield of a certain percent to investors, a reasonable 4, 5, 6% current yield, and then there's some kicker equity upside if you manage the process pretty well. And those are the kind of products that I now think are the most attractive to investors around the world. Some current yield, equity kicker, and ultimately getting some kind of maybe 15 to 16% rate of return on an overall fixed income product.
Okay, thank you. What are some of the dislocations we're seeing today in the private equity industry? And maybe I'd start with, technology seems to be a pervasive topic here. Yeah. I'm curious to see if private equity gets disintermediated in any way by technology, or what are some of the trends that you're seeing?
Yeah, it's a great question. Again, it is, technology, as you all know, is kind of, is permeating every single industry out there. You've heard of the fourth industrial revolution, the second machine age, et cetera, and that's true, and it is happening. I still believe that this private equity industry is going to continue to require a fair amount of expertise, and what are the sorts of deals, how do you structure them, what's the capital structure, et cetera. All that, I think, will not necessarily be replaced by technology, however, how you approach the deal will.
But maybe Watson would take over.
Not quite yet. But what will be interesting is, and what's important, specialists like us, is what do you bring specifically to a company to transform the operations of that business? Right. So to some extent, how do you make what I'll call it a standard multiple irrelevant? Can you double, triple EBITDA over some period of time through specific operational improvements that then change the dynamic and change the game as it relates to how you now go buy a business, how you now change that business, make that business much more profitable and more valuable to companies. One of the things that we focus on in our space is very different. Product superiority matters. If you do not understand products and software, you will not be a successful software investor. I don't care where you buy the company and the multiple that you buy it at. You have to understand the impact of products on that business, on its customers, and its customers' customers. So to a great extent, the way we think about it is that's where technology, that's ultimately where it impacts our businesses. We will end up with specialists with expertise who can now transform these businesses, not just in the software space, but in other industries. If you now understand the supply chain, the logistics much better, you can now go buy a supply chain and logistics company and make it operate much more efficiently. Mm-hmm. That massive productivity that's coming from software and technology is what's going to change the game for private equity.
Yeah, no, we agree. The power of information tends to be kind of the key aspect of our business, and we definitely see technology can disrupt that. So maybe we can talk a little bit about the evolving, unless, Jonathan, you had something you want to add on in technology?
No, not so much about technology, but about the more general proposition that Robert was raising about what we actually do and need to do in private equity.
Right.
And this applies, I think, to all of us in different forms. You could have taken Robert's point and applied it to other spaces. You need to understand what a business does. For us, it would be media and telecom, and help that business become more profitable, to grow, to take market share, maybe it's complementary product lines based on a deep understanding of a vertical, because the days are long since past when you can just buy smart, particularly in a world where everything is, when we say price to perfection, that's a nice way of saying everything's on average overpriced. And the answer to that, to doing well, is actually not what you do at the front end so much in the back end, but everything in between. What happens to that company in its life as a portfolio company? Helping that company grow, that's how we create value. Speaking for ourselves, we're not smart enough to buy so smartly up front that we can skip that step. And I think that's been an inexorable trend in private equity generally from the old days where it was a lot easier, much easier. We could just have an extended lunch instead of hearing about this, because just by being in the business, you generally did well. But today, I think it's really about changing a company and helping them. And that requires, well, one approach is deep domain understanding. Another might be very sophisticated balance sheet management.
Right.
But it's different strokes for different firms. And that, to me, is the important point.
Yeah, the key recipe for success here with private equity. So we've talked about some of the key trends. One of the things that we've seen is an evolving role between GP and LP. And oftentimes what we've seen is huge growth on the separate account side. how, I guess, one of the key contributors to that is the sovereign wealth funds. We're seeing that across, as I said, separate accounts and co-investment, and frankly, on the direct basis. So how do we think this is changing the landscape, and frankly, to some extent, how does it change your business? Maybe David, you can start.
Since the Great Recession, I would say the biggest changes in the industry are that the investors, the limited partners, have much greater sway in negotiating the terms than they ever did before. There's much greater transparency than ever before. There's much greater interest in how valuations are done than ever was before. The public pension funds are not as significant a factor as they used to be, though it's still significant. The sovereign wealth funds are much more significant than they used to be. And the sovereign wealth funds are coming in with large amounts of money where they say they want to give you much larger amounts of money than you've ever gotten before in one investment commitment, but they want many different products. They want specialized information. They want the other thing that is the coin of the realm. They want enormous amounts of co-investment, which is synonymous with free investment. So co-investment is really what many people want now, and you're seeing much more of that than ever before. But the overall biggest change, I think, in the industry is the expectations of the rates of return that GPs have to produce to keep LPs happy has gone down. In the early days of private equity, people wanted 25% net internal rates of return, then maybe 20%. After the recession, when returns were so low and interest rates stayed low, I think investors were willing to accept a net internal rates of return and be very happy of 15, 16%. So today, while we're paying high prices, the expectations of rates of return are lower, and I think it's made it somewhat easier than before to satisfy investors. And I think that's one of the biggest changes I've seen in the industry since the Great Recession. The realization that 15% net internal rates of return are heroic when you have 0% interest rates.
I got to go get some of his LPs. So let me know where you're flying next. I'll go with you.
Right.
But I think one of the keys, and picking up a little on that point, is there has been a surge of demand for us, at least, and others out of these sovereign wealth funds. And it's not just the capital that they want to deploy with us. They actually want to learn how we do what we do. There has been a ask beyond the capital and the fees and rates: is can we embed people in your organization, teach us, train us, help us learn how to make investments in our own geographies, in our own spaces, et cetera. That's been one of the biggest changes I've seen over the last few years. To Jonathan's point, I came to this industry when it wasn't easy, right? Because I'm a little bit of a newcomer in that respect. But, we have always had to work hard at it. But it's been interesting that sovereign wealth funds are now saying, listen, we want to draft off of all of the work, the decades of experience that you folks now bring, and we're going to bring capital as our tool. And what we want is your expertise in terms of how you actually do it. We just competed in a deal that we announced earlier today where there were 3 separate sovereign wealth funds who had 3 separate bids. And it's kind of interesting. You wouldn't have seen this a year ago, but we see it now where they stand up their own teams and they want to make the bid and own the companies themselves.
Mm-hmm.
One of the other trends that has really emerged over the last 5 years are special managed accounts, where an LP will work with a GP across a lot of what that GP does, and where there'll be a dialogue to create a bespoke, tailored account. So today at Apollo, we have close to $25 billion worth of special managed accounts. The largest one was with Texas Teachers, where we manage about $5 billion for them, and they're able to drive some interesting terms. It's a lot of money. It's a very good thing for us. It's flexible money, but at the same time, we give them a bit more downside protection through some cross-collateralization among funds in terms of our fees and so forth. So obviously within the SFNs that we live with,
Right.
But it's the larger, and not only larger, but many different types of LPs are looking to say, what is the skill set of the GP, and maybe they can help serve us with a lot of different product offerings put together in a specialized account.
Mm-hmm. Yeah, there's definitely a statistic out there around fundraising that we have in our shop, and it's just a little bit below the 2006, 2007 timeframe. And I think if we added in some of the numbers you've just quoted, we'd have exceeded it. So, maybe it goes back to the current pricing environment. So we talked about the globalization of the industry. There's a debate around the upside generated in emerging markets. Emerging markets tends to be the favorite topic. I know, Jonathan, you were quoted as predicting it to be the single greatest next disappointment. Do you still believe that? Do you agree with it? Unfortunately, Bonderman's not here to disagree.
Well, yeah, I think that the way we view investing, and I think this is true for most investors, it's always about risk return. So there's no such thing as a, quote, attractive return without considering risk. Just as a blanket statement, I see much higher risk in emerging markets, particularly for a dollar-based investor, because you have currency risk.
Right.
Most of our investors are dollar-based, even those that are not US investors. They give us dollars, they want dollars back. By the way, most of the fast-growing economies have inflation, so currency rears its head eventually. Secondly, there is risk around minority protection rights, law. There's actually a long list of stuff we take for granted in the US and for most of Europe. And that's all fine if you're compensated for that risk. But what we see is we don't see higher returns. Yes, there are some spectacular investments, but it reminds me of venture, where some high-profile investments do well and a flood of capital comes in. The median return is not exciting, particularly measured by realizations, because some of the largest emerging markets, 70% of the capital invested is still trapped there, has not come out. Yeah. So we don't know the answer. So I'd say in balance, earlier part of this panel discussion about GDP, return on equity is unrelated to GDP growth. And what we care about is return on equity. And so it's not that I don't think, pick the largest emerging market, China. Okay, so maybe it's growing at 4%. We could have a whole panel on what it really is growing at and not get to the answer, probably. But let's just stipulate that it's fast growing for such a large economy at a rate that the US could only dream of. I believe that. The question for us is, and we may be a little different because we're a specialist firm, but are you compensated for the risks, the micro and macro risks around that when you bring dollars back? And we haven't seen that historically, and I know what your numbers are. I think you're nodding in agreement. They're not supported by the numbers. Now, if you're a CIO of a big plan, of course you have to allocate dollars there, because how can you not be in a big part of the world that is fast growing? That's at the high level. The problem is that when many plans do that, it kind of disturbs the supply and demand of capital and drives down the return, irrespective of whether it's compelling or not. So that's my concern. And most of the risks we see, in fact, these panelists would see it on the ground. Mm-hmm. It's not generally something you read about in any of the newspapers or trade rags, but they're real, and I think generally underappreciated, and the best evidence of that is the pricing in those markets.
Well, I think you're right in many respects. The phrase emerging markets was invented in the early 1980s, and it was then designed to explain a group of smaller countries whose economies weren't so large. And the theory of emerging market investment was the prices are lower, less competition, higher growth rates, and therefore you can get higher rates of return. Jonathan is correct. If you look at the numbers over the last 5, 10, 15, and 20 years, emerging market investments do not outpace, certainly in risk-reward, the returns you get in the developed markets. Though I do think the term is somewhat dated. China will be the biggest economy in the world in our lifetime, and we're still going to call it an emerging market. At what point did the West say, hey, these people are really running gigantic economies and they're not really, quote, emerging? But leaving that issue aside, I think for diversification reasons, it is important to invest outside the United States, and it is a great opportunity in this sense, not to get higher rates of return, but to diversify. Right now, the GDP of the emerging markets, depending how you calculate, is between 45 and 55% of the world's GDP. but we're only getting about 15% of all the private equity investments is outside the United States. So there's a big room to grow, and I suspect you'll see indigenous firms, not just the ones here, but indigenous firms in China, India, Brazil, the Middle East, becoming major factors in the private equity world in those markets, and you'll see more and more money getting invested. And I suspect the rates of return will not be better than the United States, but it is a very good diversification. I think it's probably a wise thing to pursue those markets.
Right. Robert, did you want to add?
Yeah, to David's point at the end, I think the indigenous firms are the ones that we look to potentially partner with and have conversations, because they are indeed consuming the products of the companies that we buy in those marketplaces. In fact, the matter is, especially in China and other places, there are enterprise software companies that are serving just that domestic market that have astronomical growth rates that actually can benefit from the work that we do and help them run those companies better. The question is, how do you get into those businesses in the right format with the right sort of protections, the rule of law associated with it that protects our investors? And so from our perspective, we think the right answer for us is to look to those groups to partner with, as opposed to go in and stand up teams and try to sort it out and figure it out that way. But to that extent, I think there is massive opportunity continued in our space in those areas. You just have to approach it the right way.
Right. Well, we talked about realizations in these markets, which have been challenging. Actually, one of the things that we're seeing today, and hopefully it's not a theme that continues, is since 2012, it's for the first time we've seen distributions just slightly tick down. So, and we talked about returns earlier, which was interesting because clearly I think we don't necessarily believe internally yet, or haven't really internalized the expectation that overall returns come down. Is there a theme here? Is there something that we should be concerned about? What is your thoughts?
Well, first, if you take a look at the average rates of return of private equity over the last 10 years, they've averaged roughly 15%. Now, the top quartile funds are better, and everybody wants to be in a top quartile fund, and figuring out who's going to be a top quartile fund is not easy. Clearly, if you're a top quartile fund in any given area, you're going to be better than 15%. But on average, people who put large sums of money in private equity are not going to get 25% net internal rates of return. You don't put $2 and $3 and $4 and $5 billion out and get those kind of rates of return on average. So generally, I think people should expect you're putting out a lot of money to get smaller rates of return. But I think if you take a look at CalPERS, which is the biggest private equity investor perhaps in the United States, their rates of return for private equity are probably somewhere around 9 or 10 or 11% because they have to put out so much money. If you're a smaller endowment, you can get higher rates of return. I think ultimately rates of return will probably settle in the mid-teen range, maybe slightly higher if you're lucky, and that's where I suspect that they will stay for some time. In the end, I think private equity investors have to recognize that it's just not going to be easy to get these higher rates of return that people got 20 years ago or 15 years ago on average.
But
I would just say also that private equity is a long-term illiquid asset class. There's a reason why LPs are asked to lock up their money for 10 years. Basically, it involves a cycle. You plant seeds, you try to build value when you own a company, and then you look to maximize your exit. Now, the timing of maximizing the exit can come, it's challenged. You can maximize your exit if there's a good financing market through recaps. You can do it through IPOs, or you can do it through an outright sale. Now, it takes time to plant the seeds. It takes time to build the value, and then to get the right fit with the right conditions in the marketplace to maximize your exit is always an art that you can't control.
Right. We'd like it to be science, but it's art.
And therefore, I think I was infamously quoted a few years ago about selling everything that wasn't nailed down. And in fact, we did. For about 2.5 years, we sold over $30 billion of assets in our PE portfolios, and we probably invested during that period about 1/4 of that amount. I think most of my peers also in the last few years have probably had similar experiences, but I think we are in a planting and building value stage right now. Even though there are high prices out there, it would be great to sell, but many of us have already sold a big part of our portfolios, and there's less to sell right now. So of course the realization numbers are going to come down while we plant new seeds and build more value.
For the last 4 years in private equity, more money has been returned to private equity investors than has been invested. I think this year will be the first year that probably will reverse itself. And I should say that rates of return may go slightly higher than I've said before if there's inflation that comes back. I'm assuming inflation stays roughly where it is, but if inflation comes up, then returns will probably go up a bit.
Jonathan?
You know, your question about should LPs be concerned, I don't about the trend shifting. No, I think that the last 5 years we've been such strong net sellers. First of all, we should probably celebrate that because after all, it's been for this where we started the conversation about price to perfection. That sounds like a good time to sell, and we've been selling like crazy. That's number one. Number two, we still had a lot of the pre-financial crisis investments to work off, and we finally have done it as an asset class. Not quite done, but made a lot of headway. And thirdly, unlike, there's a question about implied question about duration of investments.
That was my next.
Yeah.
Right. And I think what's different about this duration extension, it looks to me like roughly about a year, from 4.3 to 5.3, whatever that, something on that order. Maybe it's 1.3 years delta. What's different, it strikes me in looking at some portfolios, that it used to be that the companies left in a portfolio were the cats and dogs. And now it's actually some of the better companies you don't want to sell because they're growing at above average rates. It's difficult to replace them. MOM is important, increasingly important to investors. After getting through a period where it was only IRR, now MOM matters. And particularly when in a low interest rate environment, it's hard to replace assets. So while it's great to get distributions, in the end to meet plan or investor obligations, we need both. And high IRRs and quick flips don't get you there in an environment like this. So I think it's actually been not something not to worry, but something that is heartening, I think, that general partners in the main have performed well based on what we know about the markets.
Okay. Well, I thought maybe you were going to do the pitch for the long hold core fund.
Well, that's coming. And
it sounded like you were going there.
yeah, no, look, that's if you're talking about asking about a trend, that's clearly one that is coming up with increasing frequency is investors, and it's different. You can actually categorize which investors like it the most. Sovereign wealth funds really, I think, were earlier on this, that, no, don't sell. We want to hold it. You may think about 5 to 7 years. We're thinking 20.
Right.
Don't sell.
Right.
And that's actually music to our ears because I think all of us have experienced selling great companies because it was the structure of our industry.
Right. Yep.
And that's about to change. We need to work out a mechanic so that GPs, I have young GPs, they're not interested in waiting 20 years for carry, to be blunt. I don't know what that implies for us, 20 years. So we'll work out that mechanism, but I think it will be a growing category, a little bit like the SMAs, that there'll be some segment, and it'll be appreciable, that is interested in long-term capital appreciation.
Well, I think one of the motivations for these long-term capital funds where you hold on to the asset for 10 years or so goes back to the history, the beginning of private equity. In private equity, when it was first started, we managed the general partners to convince the LPs that the internal rate of return is calculated from the time that the money is invested, not when it's committed. But some of the investors would say, well, when you got the money, fine, and you give me back a 20% rate of return, fine, but I have to put it back in cash for a while, and I have money in cash waiting for another capital call. If I blend my 0% cash with your 20% rate of return, I have a much lower rate of return. So why don't you just keep the money invested for a longer period of time? If it might not be 20%, but if I can over a 10-year period of time get 14, 15% over a 10-year period of time, that's actually a better blended rate of return than I would otherwise get. That's the motivation for it. And also, the sovereign wealth funds have so much money to deploy that those kind of rates of return for a long period of time are very good because they don't need to pay cash out.
Yeah, that's kind of the supply side issue. They have these pools of capital, and they're saying, listen, we need to find organizations that can take those pools of capital, manage them responsibly across multiple asset classes, private equity, credit, et cetera, don't have the friction costs of the buying and selling. And in essence, it's one of those, they tell us to create these geese that lay golden eggs, they take the eggs and they tell us to kill the goose, right? But now they're actually figuring out what we really need to do is how do we keep more of these geese in some sort of a pen. And so the approach that's coming in our direction is a select group, I'll say a very select group of enlightened large pools of capital are saying, how do we now invest with you folks for long periods of time, manage the expectations of the general partners in that context, but for us have the ability to continue to deploy and build in these specific assets that in many cases dominate their classes or large enough that can actually control a space for long periods of time to help them with the economic returns above the 10, 11, 12% that they're getting in other asset classes.
Okay. So curveball here, what is the one thing that maybe while less likely to happen is something that no one expects, potentially has a big impact on investment values? 25 words or less. Anyone?
That the consultants will be easier in dealing with the general partner. I think none of us
Geez, you
expect
throw a
that.
dig on me. I'm not the enlightened one yet either,
Yeah.
so.
I'll pick up. I actually expect that we will see an emergence of this class of long-dated funds, some of which are actually going to be initiated by the sovereign wealth funds themselves. That's what I think. We're going to see them, really take a very active role in saying control their destiny, these massive pools of capital.
And I also think one of the trends you'll see in the next 5 years or so is that non-accredited investors, those people who aren't accredited, they have $1 million of net worth, will be able to invest in private equity in some way, shape, or form. Right now, we have this ridiculous situation that if you're accredited, you're wealthy, you can invest in private equity and get higher rates of return. If you're not accredited and you don't have a good amount of money, and you aren't allowed to get these higher rates of return. So if you went to Harvard College, you graduated summa cum laude in economics, and you go to Teach for America, you are not qualified, generally, if you don't have any extra money, to be in taking your income and investing in private equity, even though you're presumably very smart. If you're an idiot and you inherited $100 million, you can take all the money you want and put it in private equity, even if you don't know what you're doing. So I think that eventually it's going to be better for people who need the higher rates of return, blue-collar workers particularly, let them invest their IRAs or 401ks in private equity. And I think that will be the biggest trend over the next 5 years that should happen and will happen.
That will definitely affect potentially investment values. A lot more money to put to work in this space. So across the stage, as I started, we have industry titans across some of the largest firms in the private equity space. If I look at the total assets kind of aggregated across the stage, not including the ones that we manage, it's about $500 billion. So, some very large firms who have created long-term value. I guess, maybe you can give us some of your state secrets on how you've grown your firms. Maybe a couple words on, how do you continue to develop your organization and stretch into the different strategies across the markets? Sure. You want to kick off, Jonathan?
Well, I think actually each of us has probably very different goals, but I think the learning for us the limitation is not actually market opportunities, but people, the people that are our partners, our respective partners, their capabilities, that to me defines intelligent growth as opposed to how big can AUM get, but what can you be distinctively competent at, it's superior at, that's what I think the limit is. And maintain a culture, however you define that.
I think,
Okay.
Go ahead.
Well,
It's to be a fight.
the way we have tried to grow the firm is very, very carefully. I think mostly carefully in trying to stick to our knitting. We've basically been in 3 products from when we started,
Right.
which is PE, which has been our largest profit maker, which has been credit, which is by far the fastest growing, and as I mentioned before, has always been in our DNA, and in real estate, which we started
Right.
about 22 years ago. We've never felt we could be all things to all people. I think the real issue is staying opportunistic on the one hand, but staying very disciplined on the other, knowing that at our hearts we are a value investor, so that whenever we expand into new products on a global basis, it has to be strategic, it has to fit in with our culture. I think Jonathan's absolutely right. It has to fit in with having the right people.
Yeah.
And it has to be done with caution.
Good.
I think all of us are great, in thinking we're good capitalists, and all of us want to be good capitalists, build great firms. But somebody sitting right there is the best capitalist in the business, Eli Broad. He's also the best philanthropist in the room. So, Eli, thank you for everything you've done for LA and the rest of the country for your great philanthropy.
Yeah. I'd echo it's for us. It's focus. It's people. It's culture, and it's really a culture of inclusion in terms of how we build our firm. So those are things that work for us.
Thank you.
Well, you just saw how David did it. He did it with an unbelievable diplomacy.
Well done.
Well, thank you very much. It looks like we're over our time, but thank you to the Milken Conference.
Good job.